Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. As the US yield surge, dollar remains in a tight consolidating range. This may be partly due to the markets awaiting FOMC outcome, and more importantly, the statement of economic projections, which will give participants some insight into what the Fed is thinking about future rates, inflation, as well as growth. Uh, Ahead of the FOMC, dollar strength in the Asian currencies is playing out. Rupee is very close to its all-time lows. Morning, JK. What are you expecting out of the rupee? Fresh low on the cards?
Yeah, good morning, Swaraj. Yeah, it'll come to the rupee in a minute because see, right now the global events are predominating. We had, continued to see sparse data, but importantly, the housing starts data showed a broad decline in the US. Tumbling to 11.3%, from last month, and actually tumbled 11.3%. And the housing sector has been one of the things that's holding up the US economy well. And the slowdown in this sector is probably going to be pleasing the policymakers who are watching, how the economy performs after the rate hikes that we have seen over the last year and more. And, in fact, from now on, rather in the last few weeks also, every data is also seen closely because the Fed is at a big inflection point as far as the interest rates are concerned. September rate, obviously not going to change, but whether there will be another hike or not is what the market is trying to assess. And this data comes at a time when it probably gives some comfort to the policymakers to keep the rates unchanged even in November. That is what the market discounting, indicates also. In fact, there was another slightly pleasing news for the Eurozone authorities because the final reading on the Eurozone inflation came lower than the initial estimate at 5.2% versus 5.3%, although the core inflation numbers remained unchanged. So that was the economic news, all that we got yesterday. Of course, Canadian inflation was higher than expected, and so although in terms of guiding the global policy, Canada plays a minor role, but still one cannot ignore the fact that the inflation is not coming down broadly everywhere, and it has been quite volatile, rising in a month and then falling another month. And Canada probably now there is an expectation that 50% probability of another rate hike in Canada, even as other countries are yet to decide where the policy will go going forward. And so if you look at the market reactions, yields were higher across the curve in the US yesterday. Almost every tenor, like 2, 10 and 30 years, made an attempt to break the previous cycle high, but they just held on, probably waiting for the Fed decision and the forward guidance on the inflation rates and growth that's expected tonight. So central banks are still in the transitioning phase as far as monetary policy is concerned, and any second round inflation effects will not be tolerated. Hence, though market does not expect September and November meeting to remain unchanged as far as Fed is concerned, they're watching out for the second round effects of inflation that can actually influence the policymakers. Nothing stops from the central banks from hiking again if they if it starts to threaten the stability on the price front. Stocks did not have anything inspiring. In fact, it wasn't surprising to see see them skid a bit yesterday ahead of the FOMC meeting. Just to get a perspective, global stocks have gained nearly 32% since last October, even as Fed rates kept rising. But market was expecting an early pause and even a rate cut. But those expectations have now been pushed back, and therefore the stocks are not finding new signs of support to go up. In fact, it's also worth noting that Europe itself is considering scaling back of its huge liquidity, and that could probably be one thing that can affect the stock market. But we have the Japanese policy, which is ultra loose even now. and the Japanese liquidity has been supporting. So it's a mixed kind of picture. Liquidity is tightening in many places. Europe on the verge of tightening. US, we have already seen that, the lot of sucking out of liquidity from the Fed, and supply side is more, means they're selling more securities. And we are also seeing the Chinese tightening the liquidity so as to reduce the pressure on the yuan. In fact, even the Indian liquidity is seeing a sharp decline in the market because of various outflows and also the tax outflows, etc. So all these things are keeping the investors on the watch as far as the stocks and the currency is concerned. There was some relief for large oil importing countries like India and Japan, both of whom have trade deficits rising due to recent price spikes. Brent slipped 1.25%, but again, that is nothing significant, considering that we had a 34% rise in the Brent prices in the last 10 weeks. Now, on the currencies, dollar came under pressure, particularly falling against the euro. On the report, which I mentioned earlier also, that, central bank may soon start discussing how to drain some of the excess liquidity in the bank system. So that supported the euro, which tested 1.07, but trading just below that, probably waiting on its hands. Investors waiting on their hands before the Fed decision. Apart from euro, GBP was slightly supported as we expect one more rate hike from Bank of England tomorrow. But again, just like the Fed, focus will be on the forward guidance. Japan also announced its policy decision this week. So I don't think in many in the market expect a change, but it is only a matter of time, maybe before the end of this year, that Japan goes into a change in the policy, because their inflation is high and their economy is not doing badly as well. Now, coming back to the rupee, about which you were asking, a new low in the rupee is very likely, and I would be guarded against assuming any big dollar rally that threatens stability, which the central bank has been maintaining for several months. After all, rupee is still a broadly managed currency, and you cannot have market forces dictating terms here. Although the direction will be in that in the way the demand and supply is going on, but anything that threatens stability due to speculative moves will be, not encouraged by the central bank. So with so much dollars being supplied in the last several weeks, demand being met, break of USD-INR into a new high is unlikely to be very dramatic. I think authorities would be okay with a move in line with fundamentals, but not when the speculative element creeps in. Also, a few factors to take note of as to the rupee is concerned: the impending Fed decision, tightening liquidity in the domestic market, and possible enhanced hedging by exporters ahead of the new year end. Ahead of the half year end, could be something that will, keep the USD-INR rally in check. And also, it's notable that, USD-INR 1 year forward premium have also inched up to 1.5%. From a low of 1.3% earlier. Just to take note of the report on global growth by OECD, global growth has been slightly improved for the year from the earlier forecast in June, particularly on India. It has been improved from 6.6% to 6.3%, whereas the inflation has been also projected to come higher at 5.3% from 4.8%. Also, from the RBI report, which was published a few days back, it's observed that Indians have spent more on foreign travel in the first 4 months of this financial year, while the foreign direct investments have almost halved at 13.9 billion versus 22.4 billion last year. So we have a lesser inflow, more outflows, and the fundamental support for the dollar rupee to remain, on the higher side. Finally, something that we should keep watching out is that US is less than 2 weeks away from a potential government shutdown, with the stakes increasing as the lawmakers struggle to agree on short-term spending bills. This is mainly due to partisan issues, and as we draw closer to September 30th with no change in the stance, there could be another tensionful period for the markets, but hopefully they resolve in the interest of the overall economy and the markets. Thank you, Swaraj. I look forward to a quiet day ahead of FOMC, but all volatility will be resolved for tomorrow. Thank you.
Thank you, JK. And just gathering the few insights you provided ahead of the FOMC, markets will be trying to assess whether there will be one more hike this year, as well as there will be focus on statement of economic projections. When it comes to another North American country, Canadian inflation was higher than expected, and another rate hike is expected. When it comes to UK, again a rate hike is expected, and their forward guidance will be looked out for. Oil fell 1.25% yesterday, providing some relief for oil importing countries. While for rupee, a new low is likely, but that will be more on a cautious side, as RBI will be managing any large volatility or speculative led flows. That's it from us today. Thanks for listening. Tune in tomorrow for another round of fresh updates. Thanks for listening.